You know, the Federal Reserve has got to be one of the most powerful economic forces on the entire planet. It can move global markets with just a few words. But for an institution with all that power, it moves at the pace of a glacier, slow, steady, and incredibly persistent.
And that brings up a really big question, one that economists have been debating for decades. Why does the Fed act so gradually? Is this slow pace some kind of deliberate strategy, or is there something else going on entirely? Let's dig in and see if we can solve this economic mystery together.
All right, to solve this puzzle, first we have to really see what we're dealing with. So our investigation is going to start with the data.
Okay, now what's really fascinating about this chart is the gap between theory and reality. That dashed line, that's what simple economic models predict the Fed's interest rate should be doing. See how it's jumping all over the place? It's reacting instantly to every little bit of economic news. But the solid line, that's what the Fed actually did. It's so much smoother, the changes are gradual, they're persistent, and they follow this really clear trend. This gap, right here, is the heart of our mystery.
And look, this isn't just some dusty academic puzzle. This slow, steady movement has huge real-world consequences. We're talking about your mortgage rate, about business investments, about the job market. If we can figure out why the Fed moves this way, we can get a much better handle on its next steps, and that means a better picture of where the whole economy is headed.
So how do we explain this? For years, the debate has really centered on two big competing theories. Think of them as the two main suspects in our economic detective story.
In one corner, we have suspect number one, the deliberate strategy theory. This idea, called interest smoothing theory, says the Fed is slow on purpose. You know, like a supertanker captain making these tiny, careful adjustments to avoid rocking the boat and to make their path really predictable. In the other corner, you've got the statistical illusion theory. This one argues the Fed isn't actually trying to be slow. Our models are just incomplete. Maybe the Fed is reacting to these long-lasting hidden economic shocks, kind of like a pilot who's constantly adjusting for turbulence that we can't see from the ground.
In this slide right here, this is exactly why this debate has been so hard to settle. It's wild. When you actually model both of these theories, they spit out predicted interest rates that are almost identical. Just look at the dashed and dotted lines. They both track the actual rate, that solid line, unbelievably closely. At a glance, both theories seem to fit the evidence perfectly. So, with two suspects that both seem to have a perfect alibi, how in the world do we crack this case? Well, the authors of the paper this is all based on did what any good detective would do. They followed the clues, using some really clever methods to see which theory actually holds up.
The first major clue they dug into revolves around a really simple question. How well can we actually predict what the Fed is going to do next?
The logic here is pretty straightforward. I mean, think about it. If the Fed is intentionally following a gradual path, if they're that supertanker captain, then their future moves shouldn't be a total shock, right? We should be able to see where they're headed. But if they're just getting buffeted by random, persistent shocks, well, their path would be way harder to predict. And at first, this clue seemed to point away from the deliberate strategy idea. There was this really influential paper back in 2002 by Glenn Rudebush, and he found that financial markets were, frankly, terrible at predicting what interest rates would do more than a few months out. And that was a huge point for the statistical illusion theory. I mean, if the experts can't predict it, how can it be a deliberate plan?
But then, the authors of this paper asked a crucial follow-up question. What if the problem isn't that the Fed's path is unpredictable, but that outsiders just don't have the same map? What if the Fed is working with way better information?
And boom, this slide gives us the answer. It compares the forecasts from financial markets, those are the triangles, with the Fed's own secret internal forecasts called green books, those are the circles. The solid line is what actually happened. And as you can see, especially before the 2000s, the Fed's own team could predict future rate changes way more accurately than anyone on the outside. This is huge. It suggests the path was predictable. You just had to have the inside scoop. That's a big point for the deliberate strategy theory. So the next piece of evidence is even more direct. Instead of just crunching the numbers, the researchers decided to look at the actual words of the policymakers themselves.
And what they found is basically a confession. Here's a quote from Fed Chairman Alan Greenspan back in 1994. He says moving in these small 0.25% steps has an advantage because, and I'm quoting here, our action becomes predictable. He's not talking about reacting to shocks. He's laying out a clear strategy to manage what the market expects.
And it wasn't just him. A decade later, you have Ben Bernanke, who was a Fed governor at the time, saying something very similar. He directly connects the Fed's gradualist behavior to two things: being cautious when you're uncertain and wanting to make policy as predictable as possible. I mean, again, that sounds exactly like a deliberate strategy, doesn't it?
So the takeaway from reading all these meeting transcripts is just overwhelming. Time and time again, the Fed's leaders talked about their decisions not as reactions to sudden events, but as part of this deliberate, step-by-step plan to guide the economy and the markets.
Okay, so after looking at the predictability puzzle and hearing from the policymakers in their own words, the paper reaches a really clear conclusion.
The verdict is in. The Fed's slow, persistent movement is a feature, not a bug. All the evidence points to the fact that interest smoothing is a core, deliberate part of the Federal Reserve's playbook. It's designed to manage expectations, to reduce uncertainty, and to steer the economy with a steady hand.
And you know, solving this mystery really matters. For investors, for business owners, for anyone with a loan. It means we can better predict how the Fed is going to react to the next big economic shock. It won't be with a sudden jerk of the wheel, but with a slow, steady, and pretty predictable turn. It confirms that the most powerful economic institution in the world isn't just winging it. It's following a consistent game plan.
So I'll leave you with this question. Now that you know the Fed's playbook is to be slow and predictable, what does that tell you about their next move as they navigate the economic challenges we're facing today and the ones just around the corner?